Hello and welcome. Today we're putting on our detective hats to solve a mystery that pretty much affects all of us, your insurance premium. You know, that price you pay. And to help us crack this case, we're following the incredible work of Dr. Sudandra S.G., who has laid out the whole process for us. So let's get started.
I mean, it's a great question, isn't it? You might live right next door to someone, have the exact same kind of car, but your insurance bill is completely different. So what's the deal? Is it just a random number they pull out of a hat? Nope, not at all. There's actually a very clear, very logical reason for it.
And here's our lead investigator. The whole answer really comes down to this person, the underwriter. The best way to think of them is as a highly trained risk detective. Their entire job is to dig into the details of every single person, that's you, to figure out exactly how much risk you represent.
Now, this detective work has an official name. It's called underwriting. And it's pretty straightforward, really. It's the process of looking at a risk and asking two big questions. First, is this a risk we even want to insure? And second, if the answer is yes, then at what price and under what specific rules?
You know, every good detective has a method, and an underwriter is no different. Their whole investigation boils down to these three steps. First, they assess the risk. They're asking, how likely is something to go wrong here? Then they formulate the policy. This is where they actually write out the contract, all the rules and the fine print. And finally, they fix the premium. They put a final price tag on it.
Right, so if you're a detective, you can't just guess. You need evidence, you need clues, you need hard facts to build your case and come up with a fair price. So where on earth do they get all this information?
Well, they have a few key sources. Think of these as their case files. First up is the proposal form. That's just the application you fill out. It's your side of the story. For bigger things, like insuring a whole factory, they might even send out an expert to do a risk survey, an in-person inspection. But the big one, that's historic claims data. This is where they look at the past to see what's happened to millions of other people or properties just like yours.
And this is where it gets really interesting. Underwriting isn't a one-size-fits-all kind of job. The detective who's an expert in marine insurance looking at giant cargo ships is looking for totally different clues than the detective who specializes in, say, your personal health insurance. They're all specialists. Let's make this real. Imagine a property detective looking at two houses. First, a wooden beach house right in a hurricane zone. The detective sees multiple risks here: wind damage, water damage, you name it. That's a high risk, so it's going to have a higher premium. Now compare that to a solid brick bungalow in a quiet suburb, far from any major threats. Fewer risks, right? So the clues point to a safer bet, which means a lower premium. It just makes sense.
Okay, let's switch gears and talk to the health detective. This is where the investigation gets way more personal. The clues aren't about building materials anymore. They are all about you and your unique personal situation.
So what are they looking for? Well, they're looking at things like your age, of course, your general medical fitness right now. They'll probably ask about your family's medical history to see if there are any patterns. And yep, they also look at lifestyle habits, things like whether you smoke or have a high-risk job. All these clues help them paint a picture of what future health claims might look like.
All right, so our detective has done all the legwork. They've gathered the clues, they've assessed the risk level. So now, for the million-dollar question, how do they turn all that information into an actual price? How do you go from clues to cost? This next step has a name. It's called rate making. And honestly, it's pretty cool. It's where the art of investigation meets the science of math. Rate making is all about using statistics from the past to predict the future. It's how they calculate a price that's high enough to cover all the expected claims. It's basically like being a financial fortune teller.
You know what? Let's solve a case ourselves. It's actually not that complicated. Let's say an insurance company covers a group of 1,000 identical motorcycles. And as you can see, each and every one of those bikes is worth 50,000 rupees. That's our starting point. Now for the crucial clue. This comes straight from their historical data, their past experience. They know that, on average, for every 1,000 bikes like these, 5 of them get stolen each year. That number, that frequency of loss, is the key to everything.
So the math from here is pretty simple. If 5 bikes are likely to be stolen and each one is worth 50,000 rupees, you just multiply those two numbers. The total amount the insurer expects to pay out for this group is 250,000 rupees. That's their total expected loss.
Okay, so to cover that expected loss of 250,000, they need to collect that money from all 1,000 bike owners. So they just divide the total loss by the number of bikes. And that gives us 250 rupees.
But, and this is important, this isn't the final price. This is just what's called the pure premium, or sometimes the burning cost. It's the absolute bare minimum they need just to cover the claims.
Because as this shows perfectly, that pure premium is only one piece of the pie. The final price you actually pay also has to cover all the costs of running the business, right? Things like administrative costs, paying their agents, putting some money aside for emergencies, and of course, a profit margin.
So, we've cracked the case of the price. But the underwriter's job isn't totally done. They also decide on the terms and conditions of the policy. And that fine print can be just as important as the price, because it determines what actually happens when you need to make a claim. Let's decode two of the big ones, because people get these confused all the time. A deductible is pretty simple. It's the amount you have to pay first before the insurance kicks in. Now, a franchise is different. Let's say you have a 500 rupee franchise. If your claim is for 499 rupees, the insurer pays 0. But if your claim is for 501, just over the line, the insurer pays the entire amount. It's a small difference in words, but a huge difference in payout.
And all of this really leads us to the core principle of insurance. This is the big idea that makes the whole system work. All risks are not equal. Some people are just more likely to have a claim than others. And because of that, you need this careful process of underwriting to make sure the system is fair for everyone.
So the verdict is in. Your insurance premium is anything but random. It is the direct result of a super detailed investigation. The whole point of the underwriter's detective work is to build a system that is fair, a system where the price you pay is a direct match for the risk you represent.
And that wraps up our investigation. So now that you've seen how the detective works, from hunting for clues to doing the final math, maybe take a second to think about your own insurance. What clues about your car, your home, or your health do you think your underwriter was looking at when they came up with your price? It's something to think about.